How should you invest $1,000? What about 10,000, 100,000, or even a million? Let's break it down, because how you invest your money changes dramatically as your portfolio grows. Before we dive into the numbers, let's get a few ground rules straight. Your portfolio size isn't the only thing that matters. Your knowledge level, your financial goals, your tolerance for risk, and even your personal preferences all play a huge role in finding the right strategy for you. Are you saving for retirement or chasing financial freedom? How would you feel if your investments dropped 20% overnight? Do you like to keep things simple, or do you enjoy digging into individual companies? We'll use 4 clear categories as our guide: 1,000, 10,000, 100,000, and $1 million. And trust me, each stage feels completely different. Let's start with $1,000. If this is where you're at, you're probably just starting out, and you're asking, what's the smartest way to invest this? This is an amazing moment. This is where your journey toward building wealth truly begins. Many people think $1,000 won't change anything, but that's wrong. It's not about how much you start with, it's about starting at all. Your focus here should be on 2 things: simplicity and building habits. Your priority is not to get fancy, it's to build the habit of saving and investing consistently. The easiest way to do this: a single, globally diversified ETF. It gives you instant access to thousands of companies worldwide, avoids the huge risk of putting everything into one stock, and it's simple. Think of it like owning a tiny slice of the entire global economy, which over the long term has always trended upwards. The classic mistake at this stage is trying to do too much too soon. Splitting $1,000 into 5 ETFs, buying a few random stocks, maybe dabbling in crypto. It just leads to overwhelm. Keep it simple. 1 ETF is enough. Plus, there's a huge psychological benefit. When your portfolio drops by $100, it might sting a little, but it won't ruin you. Living through those first ups and downs builds resilience. If you can handle the emotional swings when your account is small, you'll be much stronger when real money is at stake. Now, let's talk about $10,000. If you've reached this level, congratulations. This is a major milestone. It proves you can save consistently and that you've likely weathered your first real market swings. It's a sign that you're gaining traction. Studies even show that once people pass this mark, they're much less likely to give up because they can see their efforts paying off. At this stage, costs and portfolio overlap start to matter more. If you own a world ETF and add a Nasdaq ETF, you might think you're diversifying, but you're actually just doubling up on companies like Apple and Microsoft. It's important to check if you're truly spreading risk or just adding complexity. Psychologically, things get real here. If your account drops 10%, that's $1,000. Suddenly, the emotional impact is much stronger. The key is to stay grounded in your strategy and not let fear push you into impulsive decisions. I like to compare reaching $10,000 to working out at the gym. At first, you weren't sure it would work. But after months of consistent effort, you see the results in the mirror. $10,000 is the visible muscle of your financial fitness. Next up, $100,000. Crossing this mark is a game changer. This isn't just some money in the market anymore. This is real wealth. This milestone usually reflects years of discipline and patience. So, how do you protect this wealth and still grow it? Your broad ETF foundation is still your core, but now you can add new asset classes. For the first time, buying real estate becomes a realistic option, whether it's your own home or a rental property. With $100,000, you finally have the breathing room to do this without creating dangerous concentration risk. You can also start broader diversification with more ETFs, maybe a few individual stocks you really believe in, or even REITs. But here's the new challenge: the emotions of bigger numbers. If the market drops 10%, you're down $10,000. For many, that's when a loss feels truly frightening. This is where many investors sabotage themselves by selling at the wrong time. The solution: trust your long-term strategy and remember that market dips are normal. And now, the $1 million mark. If you've crossed this threshold, you've joined a very small group. This doesn't happen by accident. You've mastered the fundamentals of wealth creation, but with big money comes big responsibility. Your focus shifts. It's no longer about chasing the highest possible returns. The priority is now wealth preservation. Too many people hit 7 figures, get overconfident, and start making reckless bets that wipe out years of effort. The smarter approach: keep your base safe, diversify broadly, and take only calculated risks. With $1 million, new doors open up. You can invest in real estate at scale, maybe even become an angel investor in startups, or look into alternative assets like private equity. But the golden rule is, never invest in something you understand just because it sounds glamorous. Think of it this way: you might put 70% into a diversified portfolio, 20% into real estate, and maybe 10% into something more adventurous like startups. This gives you stability, passive growth, and just enough excitement to stay engaged, all without losing sleep. The biggest psychological trap here is absolute losses. A 10% drop means $100,000 is gone. That number feels devastating. You have to learn to see losses as percentages, not dollars. $100,000 loss on $1 million is the same percentage-wise as $100 loss on 1,000. Your mindset is everything. At this stage, many people consider hiring a fee-only wealth manager or a commission-based one to help with the complexities of tax, legal, and estate planning. But even with expert help, the responsibility is still yours. No one will care about your money the way you do. Finally, remember that risk is a personal journey. Your ability to take risks depends on your wealth and your income. The timeless principle of diversification, not putting all your eggs in one basket, is your best friend at every stage. A broad world ETF is a powerful foundation because it automatically spreads your money across businesses, industries, and countries. Whether you're starting with $1,000 or sitting on $1 million, the most important thing is your mindset. Are you thinking long term? Can you handle volatility without panicking? Wealth is about freedom. The freedom to choose how you spend your time, to be with people you love, and to pursue what truly matters to you. Money alone won't make you happy, but it can buy you the time and space to live a life that does. Thanks for watching. If this was helpful, please give it a thumbs up and subscribe for more content to help you on your financial journey. See you next time.